Fisker is setting up for a massive expansion over the coming years. In this video, I will go over that expansion. I will go over the financials of this company, and then at the end of the video, I will give you a price prediction based on technical analysis. So with that all being said, let's dive right into this. So Fisker is ramping up production and deliveries of Ocean SUV model. The EV company announced that the company is ramping up production capacity of the Fisker Ocean all-electric SUV in September. The EV startup also said that it is expanding retail, delivery, and service operations across multiple markets in North America and Europe. The expected ramp-up of Ocean model will see production go from approximately 180 vehicles per day to approximately 300 per day in Q4. Fisker said it is working with suppliers to achieve the targeted run rate in October. Production is for consumer deliveries in Australia, Belgium, Denmark, France, Germany, and Netherlands, Norway, Sweden, Switzerland, and the UK, and for Canada and US markets. So definitely a massive expansion, big news for the company. But with that being said, let's go into a little deeper on the fundamentals of this company. So this is an article written by the Asian investor on Seeking Alpha. He says that Fisker has lowered its production outlook for fiscal year 2023 again due to the supplier issues, and they're now expected to deliver anywhere from about 20,000 to 23,000 EVs. The company is aggressively expanding into Europe with deliveries already starting in Denmark and Germany, and it has plans to launch in Belgium, Netherlands, and Switzerland in the near term. Fisker's revenue base has quadrupled from Q1 to Q4, but is still relatively low compared to other EV manufacturers. So the EV startup has made a couple of important announcements lately that affect its delivery ramp up in Europe. The company is aggressively entering new markets and is seeking to establish a wide range service network in Europe. Recent announcements about the company's expansion in Europe, however, were overshadowed by Fisker's lowering its production outlook in fiscal year 2023 again, as a key supplier requires more time to prepare for Fisker's expected production ramp up in the second half of fiscal year 2023. And this is typical, right? I mean, it's really hard to make an EV. So obviously they're having some issues kind of getting out of the gate here. Yes, they're out of the gate, but they're still kind of stumbling out of the gate. And that's just because they're still expanding their production capacity, and it's just going to take time. But once they, kind of perfect their manufacturing, the sky's the limit for this company because the demand is for sure there for their vehicles. So Fisker is moving into Europe with determination and speed. The EV startup has started deliveries in Europe, in Denmark, and Germany, and in the US in the second quarter, and the company is set to launch its Fisker Ocean EV in Belgium, the Netherlands, and Switzerland. The company is investing heavily to build Fisker lounges and centers throughout Europe, and the company has said the regional deliveries in Belgium and Netherlands and Switzerland are expected to start at the end of September. Fisker is in early stages of growth, growing its revenues, and the company has managed to quadruple its revenue base for the first time, from the first to the second fiscal quarter of this year. Granted, it's very low volume. It's 1 million in revenue in Q2. And then the prior quarter was 10 grand. So obviously, we're in early stages here. We're in very early innings for this company, and shares of Fisker are currently valued at 6 times forward revenues, while other EV manufacturers are selling at significantly higher price to revenue ratios. Shares of Fisker are currently trading 42% below the 1-year average of price to sales ratio. Lucid has a fiscal year 2024 price to sales ratio of 7.1, while Fisker has just a 0.66 price to sales ratio. So you're seeing a name like Lucid almost trade 7 times more expensive when you look at the price to sales. But with that being said, let's take a look a little deeper into this company's financials. So currently, we have a price to book ratio of 5 times, which for those that don't know, that basically puts the market cap relative to the book value of the company. So that's not a horrible number. Obviously, we don't have a positive PE, so it's kind of tough to really grade this company harshly on valuation. And then when we look at revenue growth, obviously it looks great. We have a 1,600% revenue growth rate. And then revenue growth for the next 12 months is actually projected to be about 3,000%. So massive growth. Obviously, we're in early stages, so that's pretty typical. One thing I do like to see, though, is that gross profit margin is at 13%, which is well below the sector median, but is still positive, right? And for those that don't know, this gross profit margin tells me what a company makes for what it sells. Simply just revenue minus cost of goods sold. And then we can see here that we also have $1.36 of cash per share, which is about 20% of the market cap in cash per share. So that definitely signals a decent balance sheet. But with that being said, let's take a look at all of these financials and compare them to the peers and see how they grade out. So for Fisker, we have $470 million in cash, and we have $713 million in debt. So that means that we have $243 million more debt than cash. And then when we take a look at Lucid and Rivian, so Lucid Rivian definitely has better balance sheets than Fisker. It's just undeniable. For example, Rivian has $10 billion in cash, only $3 billion in debt. Lucid has $5 billion in cash, only $2 billion in debt. Tesla even $23 billion in cash, only $5 billion in debt. XPEV even $3 billion in cash, $2 billion in debt. So the balance sheet is honestly a poor one when you compare it to the peers, unfortunately. Wish that was different, but it's just reality for us. And then if we were to look at short interest as well, we can see that the short interest for Fisker is actually higher than any of these stocks. So in terms of a short squeeze, Fisker definitely seems like the most likely candidate. And then profitability here. So profitability is really where Fisker is shining. So we have a 13% profitability, a 13% gross profit margin, which is above Lucid, above Rivian, above NIO, above XPEV. It only is below Tesla. So this is the second best profitability profitability number when you compare all the EV companies. And then growth numbers, obviously this growth number is definitely unsustainable, right? We're not going to grow at 3,000% a year. So obviously Fisker's growth number is the highest, and Fisker is really in the earliest stage when you compare them to all these other companies. And then in terms of valuation, when we look 3 years down the line, Fisker is actually projected to have a 16 times PE, which is actually better than all of the other peers. So 3 years down the line, in theory, because these are all projections, once you go out multiple years, you're just making a projection based on the company's expectations. So we're projected to be profitable 3 years down the line. Does that mean we will? No, but it is definitely a good sign that the company is at least setting their base case as a profitability company in 3 years down the line, and that would be a 16 times PE, which is actually below the market multiple. So definitely a good number there. And then on a price to sales basis, this company is the second cheapest. So NIO is the number one, but we're a lot cheaper than Lucid, which trades at a 13 times price to sales. Rivian, which trades at 3.6. And then Tesla, which trades at an 8.5 times price, or excuse me, EV to sales number. And then price to sales, unfortunately, we're very expensive. We have a 1,600 price to sales, which is well above Lucid, well above Rivian, and well above all the other peers. So with that being said, we went over the financials. Let's take a look at the company's analyst ratings on Wall Street. So we have 8 different Wall Street firms that are bullish on this company, 4 different Wall Street firms which are bearish, which signals that there's kind of a this is really kind of a battleground stock, right? Or we're kind of 8-1. I mean, it should be 8-4 in terms of bulls to bears, which tells you that there is kind of a wide range of opinions throughout the stock market, but it is good to see that at least we have more bulls than bears on the market. And the most recent change in rating was a price target drop by $3 to $15, but Citigroup still maintained their buy rating. That was just in August. So not that long ago. Definitely still a bunch of Wall Street firms bullish on this stock. And then with that being said, let's take a look at the chart and see if we can't give a logical price prediction. So we've been over this 200-day moving average for the longest time, since November of 2021. So definitely signaling that momentum is really turning around for this company, right? We haven't been above this 200-day moving average for this long since 2021, signaling bullish momentum for the stock, which I do love to see. Unfortunately, we are coming up to a level of resistance at around $7, which is where shares had topped out in August and June. And we're coming up to test this level of resistance as shares are oversold, or excuse me, as shares are overbought, according to RSI. So overbought condition coming up to a major level of resistance. We could see some consolidation around this level, but given how bullish momentum is, I think we could, kind of burst through this level. If we burst through this level, I do think we could see a move up to about $8 over the coming weeks, as this is kind of the next major level of resistance for the stock. It's where the stock topped out in February. It's where the stock topped out in January and in December of last year. So if we're able to break through this resistance level at about $7.10, I think we see a pretty quick move up to $8 over the coming weeks for this stock. And then if we were to take a look at which months the stock typically does well in, which months the stock typically does poorly in, we could see here that in September, shares do typically rise like 1% on average about. And then October is actually the third worst month in the stock's history. November is a bad month. December is a bad month as well. So just keep that in mind. Obviously, only 4 years of pricing data here, so not the end all be all. Like I said, this shows me the average monthly return of this stock. So with all that being said, I think this stock is really making some massive moves to kind of improve production and move towards profitability, which I love to see. This stock is really growing at a very high clip, which is awesome to see. But I would want to see the company deliver on a couple more promises before I really went, before I kind of went long on this stock for in my long-term portfolio. But I do think it definitely has a awesome opportunity to take advantage, and I'm really excited to kind of watch this company grow over the coming quarters. So with all that being said, I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.